When you think of Warren Buffett, you probably think of the ultimate conservative investor, a man who buys sturdy American companies, holds them forever, and famously avoids any financial instruments he doesn't understand. In his 2002 letter to shareholders, he explicitly warned the world about derivatives, complex financial contracts tied to the value of an underlying asset. He called them financial weapons of mass destruction, carrying latent dangers that were potentially lethal to the economy. But shortly after publishing that warning, Berkshire Hathaway quietly became one of the most prolific options traders on the planet. Over the next few years, Buffett personally approved the sale of billions of dollars in the exact derivatives he had just condemned. How does the world's most cautious billionaire publicly denounce a financial tool while simultaneously using it to execute massive trades?
Buffett identified a specific blind spot in the mathematical formula governing the global options market. By exploiting that flaw, he could collect enormous cash premiums, acting as an insurer for a terrified Wall Street. To understand what Buffett saw, we have to look at the math Wall Street relies on. In 1973, Fischer, Black, and Myron published a mathematical formula to determine the fair price of an option. It eventually earned a Nobel Prize. The Black-Scholes model functions like a pricing machine. To calculate what an option contract is worth, it requires 5 specific ingredients. 4 of those inputs are hard, fixed numbers you can look up: current stock price, target strike price, time left, and the risk-free interest rate. The 5th slot is the wild card: volatility. Since no one actually knows the future, this input is a pure forecast of how violently the stock price might swing. As we look at this expanding model, the core assumption of Black-Scholes becomes clear. The formula assumes stock prices move in a random walk, meaning they wander unpredictably. The further out in time you project, the wider the potential variance, driving the mathematical risk exponentially higher. Because the math assumes this chaotic random walk, the model rigidly dictates that selling long-term options carries significant risk. That makes those contracts highly expensive. Buffett looked at this academic theory and applied a very different practical logic. We can see exactly how he operates by looking at his 1993 strategy with Coca-Cola. He wanted more shares of Coke. The market priced it at $40, but he refused to pay that. He wanted to pay $35. This graph mapping out his play shows how he bypassed a standard buy order. Instead of waiting for the price to drop, Buffett sold 50,000 put options, binding promises to buy 5 million shares of Coke at exactly $35 if the price fell. By making that promise, he didn't have to walk away empty-handed. He immediately collected $7.5 million in upfront cash premiums from the market. If Coke's price stayed above $35, the contracts would expire harmlessly, and he kept the $7.5 million for free. If the price dropped below $35, he would be forced to buy a company he already wanted, at the exact discount he demanded. Between 2004 and 2008, Buffett decided to scale this strategy. Instead of targeting a single soda company, he placed a massive bet on the global economy by writing contracts on 4 major international stock indices. To do this, he targeted a failure point in the Black-Scholes model. The formula is highly accurate for a 30-day contract, but when the timeline stretches to 20 years, the math loses its grip on reality. This chart highlights his counterlogic. The model assumes a 20-year horizon is an expanding zone of pure random chaos. Buffett argued that the U.S. economy has a historical upward bias driven by continuous corporate growth that the math ignores. Knowing the academic formula was overpricing the risk, Buffett sold long-term put options on these global indices to a panicked market. In exchange for promising to cover market losses years into the future, he collected $4.9 billion in cash. He bet on long-term human progress to exploit the mathematical fear perfectly encoded into Wall Street's pricing models. There was one crucial catch to these index puts. Buffett specifically sold European-style options. This meant the buyers could not exercise their right to sell early. They were locked in until the contracts expired, 15 to 20 years later. By locking those buyers out, Buffett essentially secured a $4.9 billion interest-free loan up front. He took that mountain of cash and invested it directly into Berkshire Hathaway's operating businesses to generate even more wealth. The final condition was simple. As long as the stock markets were higher in 2026 than they were in 2006, Buffett wouldn't have to pay a single cent back. He would keep the entire $4.9 billion. This resolves the apparent paradox of his public warning. When Buffett publicly called derivatives weapons of mass destruction, he was talking about complex, unregulated, highly leveraged contracts. He views selling simple puts exactly like his insurance business. He collects a premium upfront to protect policyholders against rare catastrophes. Success in this scale requires recognizing exactly when rigid academic models fail to capture the reality of long-term economic growth.